The bottom section of the slide shows a journal entry from a previous slide where we issued bonds and received 104% of maturity value, probably because the interest rate on our bonds was higher than other bonds. This created the need for the premium on bonds payable account. Now at the top of the slide, bonds payable, $100,000 maturity value, plus the premium of $4,000 gives the carrying amount of the bonds, $104,000. The company would report these bonds payable with a carrying value of $104,000 on the balance sheet. Next, we'll see how the premium on bonds payable affects the journal entry to pay the semi-annual interest. At the top is our journal entry when we issued the bonds. Notice it created the account called Premium on Bonds Payable. At the bottom of the screen in white is our final journal entry. Years later, when we retire the bonds, so we get them off the books with a debit and pay the bondholders a maturity value, $100,000. The company borrowed $104,000, but will only pay the $100,000 maturity value when the bonds mature 10 years later. So when the bond matures, we will have to debit bonds payable and credit cash $100,000. But we also need to get the premium on bonds payable account amount off our books too, since the bonds will no longer exist when they are retired. So over the life of the bonds, we will want to gradually reduce the premium on bonds payable until it is zero when the bonds are paid off. That way, the final entry years later to retire the bonds is bonds payable $100,000 debit and then cash $100,000 credit. And that way, the bonds payable account will be off our books and the premium on bonds payable account will also be off our books. So let's journalize the payment of the interest, and in the process, we will also gradually remove the premium off our books by reducing it. We know cash is going down, so that's a credit. The formula to pay the interest is principal times rate times time. Since bond interest is paid every 6 months, the time portion of the formula is 6 months divided by 12 months. That gives us $4,000. Now we're going to divide the premium on bonds payable over the number of interest payments. The bonds are 10 years and there are 2 interest payments per year, so there are 20 total payments. $4,000 divided by 20 interest payments means we need to lower the premium account by $200 each interest payment. Interest expense will be the balancing amount. $4,000 minus $200 gives us $3,800. Now the transaction balances. So over time, what becomes of the $2,000 premium? Well, the premium lowered interest expense as it was amortized, reduced over time. Instead of $4,000, interest expense was $3,800. The premium lowered interest expense through a process called amortization, which is the gradual reduction of an item over time. We can amortize, gradually reduce, a bond premium by dividing it into equal amounts for each interest period. This method is called straight line amortization, and it works very much like the straight line depreciation method. It's called straight line amortization because you divided equally. You divided the $4,000 into the 20 interest payments equally, giving you a straight line, in other words, the same amount of amortization each period.